All good, thanks yourself.
Very good indeed. We were just saying that this is the Lewis that we like. We've had Lewis in CAFs, we've had Lewis on
Yeah.
train platforms,
Yeah.
um, we've had Lewis at home, I think, in the office. But today you're in Ireland, if I remember rightly.
Yeah, Belfast, Northern Ireland.
Very nice. So, Andrew, you ship him around all over the place, right?
Yeah, gotta keep them busy.
You're definitely keeping him busy. Good morning to everybody. Thank you all for joining us. I believe the chat function is available as well. So if you'd all like to just say hello and good morning so we know stuff is working, that would be absolutely perfect because for some reason, there we go. I can see the chat now as well. So, guys, where is this month going already? Sitting on the 19th of September. It is flying round again, isn't it?
Yes, definitely. It's honestly, I was looking at the other day. I think we initially started doing these ourselves this time last year
Yeah.
almost, and honestly, that scares the hell out of me.
Crazy.
Yeah, having quite a lot of conversations now with a lot of people around planning for 2026, and even that just feels absolutely surreal. Yeah, definitely the bit where summer feels amazing. Everyone's sort of waiting in the build up to it. Everyone's really excited for the holidays. September comes, and it's like, oh my God, it's now mad rush to the end of the year. So,
Yeah, it's just crazy. How was your summer? Was you still busy? We found it unusually quiet this year. It was we found a lot of advisors were having a bit of downtime. I suppose a lot of their clients were having a bit of downtime, so they had a bit of downtime as well. But how were you guys? Were you busy?
yeah, we we
No,
probably
no thanks for the wicked.
no, yeah, we use it as a time to get a lot of the projects that we want to do done. We
Yeah,
also welcome senior members of the team. So we've now got a relationship manager for Scotland and Northern Ireland. And we've also got a regional director who started in the north as well. So we use it to
smashing.
basically hire, get them onboarded, get them in
Yeah,
the team. And yeah, actually, we did find quite a few people still wanting meetings, especially in the first couple of weeks of August.
good.
I think a lot of them are trying to get a lot of work done before, yeah, maybe later end of August, a lot of holidays, etc. So,
Yeah,
yeah, still super busy, and it now seems that September's even busier.
absolutely, guys.
All good stuff though.
Absolutely.
Wouldn't have it any
Yeah,
other way.
absolutely. So. Let's kick things off again. Just thank you everybody for joining us today. We do plan for the webinar to run for the full hour as per usual. Do make the most of your time with us. Please ask as many questions as you'd like over to Lewis and Andrew. The chat function is there for everybody to see. The Q&A function keeps things a little bit more anonymous. So if you want to ask a question directly, but not on the open forum, please do use that channel if you like. We do have one poll for you today that will kick off quite early on, and then you can kick back and listen to the guys as they walk you through a really, really good presentation today. Feedback is always important to us, so please do take a couple of minutes at the end of the webinar. When you exit and leave the webinar, there will be a little feedback form. This will give you time to give your feedback on Aspen's presentation today. It'll give you the chance to speak with Aspen as well, and similar to some of our stuff as well, you can get involved with us. So please do take your time to complete the feedback form. It literally takes 2 minutes. As always, let's kick things off. I love to tell people a little bit about the club and what we're doing. Things are forever changing. Client demands and what they're looking to achieve over the next quarter is a forever moving goalpost, but it's good, it's fun, and it's really exciting at the moment. The club is built for business owners. We provide the structure, clarity, and accountability, helping you stay focused, save time, and make that progress. You're really surrounded by people who want to see you succeed. It is about direction, those structured business plans, clear 90-day sprints, all tailored to what you want to achieve within your business. Most importantly, it's the ongoing accountability to actually get you there as well. We're helping firms grow, unlock new opportunities, using strategies that work. Whether you're looking to streamline your systems, automate some operations, it's all about helping you grow as a business, helping you scale or service your client bank without that physical burnout, which is quite important. You're never alone. We've got an amazing community of collaborators, very much like Aspen and other business owners as well. You've really got a network of peers and experts who get it. It's a safe space to talk, reflect, and grow. Sometimes it's about clarity. People just want clarity. With the right support, you'll know exactly where you're heading and what actions matter most right now. So it's very thought-provoking, very strategic. We're there to guide you and direct you as well. That ultimately gives you the confidence that you are making the right decisions. You're making them more easily as well. all around, it's just a really good place to be when you're feeling confident about your business for sure. Most of all is capacity. We want to give you a lot more time back to yourself. We want you to free up your time so that you can focus on what you enjoy doing, and that's seeing your clients and really working in and on your business. So that's really the membership side for the business owners of the club. Aside from that, apologies, I'm a bit croaky today. Kids are back to school, so colds and flus and everything else comes flooding through the house of a September. So it's amazing. Aside from the business owner membership, we want to build a community that works for absolutely everybody. So any professional. Your power planners, your administrators, your advisors, your mortgage advisors, your ops, anybody within the industry, we want to provide a community to you. So that starts within our WhatsApp groups. These groups are absolutely buzzing. They're growing every single week. I think we're up to about 1,400 club community members now across the separate WhatsApp groups as well. It's just quick answers. There's no fluff within those groups. It's all meaningful conversations. If you're stuck on a particular case, finding something a little bit challenging, there's somebody that's already walked the path and got the answers for you. So it's a really good place to hang out. Webinars, expert-led, got the guys with us today from Aspen. It's practical and it's CPD accredited. We know nothing beats face-to-face events, so our in-person strategy events, if you like, are there to build better businesses and better relationships. Podcasts, these are great. You can listen to these on the go on all major platforms. They're aimed at business owners that come on and share their stories, their highs, their lows, their ups and their downs, and where they are today. We were at the Verve conference last week. We recorded 21 episodes live, so that was definitely an experience. We do run quarterly CEO roundtables as well. So it's more strategic working on your business there and then with the business owner side of things as well. So it's a really good place, whether you're running a business or whether you're working within a financial planning business, the club can absolutely give you some support and guidance. And I've touched on it briefly. We are on tour. We are going around, got a couple of events lined up. We're in Leeds next Friday the 26th of September. We're in Leeds. Lewis, I know you're with us. So make sure you're back in time. Don't stay in Ireland for too long. Following that, on Friday the 28th of November, we're over in Birmingham. These are exclusive for business owners and really standalone self-employed advisors, advisors who are wearing multiple caps at one time. So if you're in the area and you've got some availability, please do come along. To give you a bit of an insight into the agenda of those workshops or their strategic days, if you like, we're kicking off with a personal motivators session. It's really enabling you to rediscover your why. It's a really highly interactive, thought-provoking session, which is really, really good. We then look at strategies at winning and retaining clients across multiple generations. You've got the big wealth transfer that everybody's talking about at the moment. So we're actually putting together a plan on how you can engage with different generations, which would be really good and interesting. And then we finish off with building a client referral scheme that actually works. So everything we do at our club is collaborative, at our event, is collaborative and interactive. Sitting and listening is not something that we want in the room, so everybody gets involved. There's 5 hours of CPD and it's completely free. Couple of webinars that we've got coming up with Timeline on Friday the 3rd of October. So this session focuses on client confidence, especially in volatile markets. So we're going to explore how Timeline's visual planning tools and low-cost, high-performance portfolios can help advisors calm nerves, build trust, and keep clients on track. Following that, we're with Saturn. Love the guys over at Saturn. Love things AI. It's very topical at the moment. So this AI is really transforming compliance and de-risking the advice process. And we're going to cover how AI can support compliant conversations, generate audit-ready reports, and reduce that regulatory risk as well. So whether you're new to AI, exploring it, or currently using it, it's a really good session that you should come along to. Again, we can't do what we do without the incredible support of all of our collaborators. Each and every one of these businesses do play a key role in helping members navigate change, implement new ideas, and everything else in between. They share a commitment to moving the financial planning profession forward. Their expertise, their innovation, and genuine desire really does make a big difference. So again, just a huge thank you and a well-deserved shout out to everybody collaborating with the club. You do play a vital part of many of our members' journey. So that leads us on today, guys. We are joined by Aspen, Andrew and Lewis. Andrew is the CEO and the founder of Aspen. Launched back in 2019 with the goal of transforming the MPS market, and that's exactly what you guys are doing. We're absolutely loving it at the moment. The feedback is very good. Alongside him is Lewis, who leads Aspen's strategic relationships and supports firms, as you know now, across the UK. So today, they'll be helping us explore one of the most important challenges in the investment planning. Can you protect capital and still achieve meaningful growth, especially for cautious investors? So we asked the attendees to answer some questions when they registered. So this slide really does pull together some of those key insights from the questions that they were asked. So we see, or we can see four clear themes here. So low risk portfolios, smoothing funds are being widely used, with many also leaning on cash holdings, phased investment strategies to manage that client anxiety, if you like. On the right-hand side, we were talking about, or attendees definitely told us that they're currently reviewing their CRP, or have done so recently. Some review it every 6 months. Some are looking to review it in the new year. So we've got a good bunch of people with us today. It's a really good audience. So those insights, guys, is that what you're seeing across the industry now? Is that pretty much the norm?
Yeah, definitely. It's getting definitely a mixture of approach. One of the things, obviously, we'll talk about today, we did a poll on LinkedIn recently, or Andrew did rather, bucketing strategies and that sort of bucketing of wealth, whether that be a two-pot approach or a three-pot approach, whatever it may be, is definitely the most popular option used by advisors and planners now. We're seeing some start to shift away from some of the traditional smooth fund options and other bits of piece in the marketplace at the minute. But yeah, like you said, a lot of that around sort of the communication education piece for clients. It's understanding what your time horizons are, what you want that retirement to look like, and understanding to clients obviously how markets work, and really trying to give them a lot of peace of mind, because it's all well and good investing in the markets when you're trying to accumulate wealth, but when you're trying to take income, it's a lot more sensitive, and maybe some additional education needs to be done on that. But yeah, definitely something we're seeing at the moment. And I think as a result of that and the FCA retirement income review recently, yeah, a lot of firms are now having to not only review their CIP, but been a big emphasis now on putting a CRP together. And I think we're going to be doing a white paper on this hopefully beginning of next year. And it's one of the key things that a lot of compliance firms look at, is actually saying to their businesses now, you need to have a CRP in place. If you haven't got one, you need one very soon. So yeah, expect that to be a strong focus for 2026 in particular.
Love it. And in your experience, how often should people be reviewing their their
Oh,
CRPs? You know, is
great
that
question.
is that the killer question? You know, is it one of those things that you go, right, we've done it for the year, let's let that ride out, or is this something? Is this a continuous keep an eye on it? What's your views on that?
I think it's a bit similar to us as investment managers. You know, we obviously have the funds blend of passive and active options in portfolios, and I think if we just then didn't do ongoing research for potential improvements or have things on the bench in case something happens, then that probably wouldn't be a prudent thing to do. So I think one's CIP and CRP should be kind of an ongoing open-mindedness, going to events and, speaking with others and seeing what else is out there. I don't think changing things, often is a good idea. Really, you want to, get in with someone or a few firms and kind of back that. But I think it's important to, always stay open-minded and consider what's in the market as it's evolving.
Yeah. Just to echo that, I think this is a good example. I was actually down in Southampton yesterday with a firm who are outsourcing for the first time. And we were speaking about that particular question. They said, look, how often do we need to meet formally? Like, how often should we be reviewing our CIP?
Mm.
And problem is, and this is why I do really feel sorry for obviously a lot of people on the call today, when it comes to the review side of things, You've got over 4,000 funds in the marketplace. You've got over 200 MPS providers. If you literally reviewed the entire market on a regular basis, that's a full-time job for a
Yeah,
team, yet alone one individual. So you mentioned that in the call. A lot of the self-employed advisors or smaller financial planning businesses that are wearing many hats, it's impossible to do.
of
So
course.
I think it then comes down to the key question of how do you review your CIP, CRP, comes down to, are you doing this in-house, so building your own portfolios and building your own bespoke solutions? If so, yeah, probably once every 3 months is a minimum. You need to be having those investment committee meetings. If you're outsourcing, then actually probably either 6 monthly or yearly works to have a formal review where you go through the process of everything. There's what Andrew mentioned. Sometimes it is just about going to events, attending things like these, taking some useful snippets throughout the year. Because when you put your CIP together last year, 2 years ago, 3 years ago, you were based off the information you had then. You've now got so much more information available to you and new solutions that come into the market each day. So yeah, it is important to just continually check on what's going on around you. But yeah, set a formal date, I'd say at least every 6 months, if not yearly, would be a good place to go.
I think we're definitely seeing a move in the market from firms building their own
Yeah.
CIPs and doing it all internally to outsourcing it now. I think there's a big shift happening. I speak to, less and less advisors that are getting creative and creating their own portfolios and CIPs and whatnot to outsourcing it and using more MPS and leaving that skill set to those that are doing it on a daily basis, right?
Yeah. But also, the challenge that we're seeing at the minute in the marketplace is some people want to sort of push it to one side and like, okay, it is what it is, doesn't really matter. Or actually, when we're talking about planning for client goals, it's putting that plan in place is probably one of the most important things you'll do, which is obviously
Mm,
why, as an industry now, and even the club, everyone's moving towards financial planning as opposed to financial advice.
mm,
Whereas what people need to start realizing, and a lot of advisors now are starting to realize, is that the investments still form a very core part. That's actually how you then hit the goals you're trying to achieve. How do you meet the expectations, get the investment growth that you're wanting to get to then meet those
mm.
goals in the future? So the investment part is still massively important, which is why, yeah, people should definitely be looking at it at least 6 monthly or yearly, and having a formal review. It shouldn't just be something that's put to the side and not really paying attention of.
Yeah, thank God that job's done kind of thing, right? It's something that you got to constantly review, and like you said, sort of every 6 months, every year. So that leads us on to the first question. So, what is your current approach for those clients approaching and in retirement? Is there something that you see happening across the industry? Is there where would you cast your votes if you was answering for a
Uh,
typical firm? Would you say?
yeah, so um, I've done a couple of polls on LinkedIn this year to kind of see where the mood is, and yeah, it's been about 250 respondents, and it's been about 55% bucketing approach, 25% drawing from for example, here a balanced portfolio, and then the remaining 20% a range of kind of other options. So yeah, I think the conversations we're having tend to be leading towards the bucketing approach. When we were creating our CRP over the last couple of years, we did a lot of feedback sessions and obviously looking at the FCA's retirement income review, and we landed on the bucketing approach that we felt was a pretty sensible and easily understandable way of doing things for the advisor and for the client. And but I think drawing from a balanced portfolio or something is still a perfectly reasonable option. And so we're seeing here clearly that those two approaches are the preferred kind of approach still.
So that it's just being echoed across the industry, whether you're running a poll on LinkedIn or whether you're running a poll on Zoom, everybody seems to be ticking similar boxes then.
Yeah. Yeah, it seems to be definitely consistency there with the results now versus what we've been doing. But I think the beauty of what people need to realize as well, it's about independence. It's about having the freedom to say, actually, some people might want a bucketing approach. Someone might want cash and equities that we got here. Someone might want to draw down from one risk rated portfolio. You've got to believe in this. you've got to do the research behind it and you've got to believe in this. So as long as you've done the research, you feel comfortable, brilliant. That's what it should be about. If we're all doing the same thing, you start to lose a little bit of that independence.
Yeah.
If we're using the same approaches, same solutions, etc. So yeah, independent and sort of diversity of thought is really, really powerful in our industry. So yeah, it's good. It's actually good to see a mixture of results. You don't want to see everyone doing the exact same thing as one another.
No, no. Smashing, guys. The floor is yours. You should have full permissions to share your screen. If not, I've done something wrong my side. But fingers crossed, you're good to go. And just want to echo, if you've got any questions at any time on any particular slide, or if you want to ask anything, please don't, worry about interrupting. Just send your messages across, and we'll happily jump on those and answer them for you.
Is that sharing working okay?
Absolutely fine.
Great. Well, thanks for all that intro, and thanks very much for a bit of time this morning, everyone. Yes, as Lee said, this is very much interactive discussion. We've got a nice group here in terms of a good number, so please do ask questions along the way. We at Aspen are investment specialists. We're pretty agnostic in terms of how we kind of create things. We're not kind of strongly in one camp or another, or have any significant bias. So we're very happy to kind of opine on things in a relatively neutral manner. So any questions on anything on the investment side, but obviously we're focusing on protecting and growing capital today, and then please do ask away. So Lee's kindly done the intro. So I'm Andrew, CEO of Aspen. Started it around 6 years or so ago. Been around 20 years in the industry. Good chunk of that in the last sort of 12 years in the MPS space. So really when it started, sort of 2011, 2012, with a firm in London, and then moved back to Scotland 7 or so years ago, before starting the Aspen business. Really, the objective of the business was, I felt there was a lot of very similar solutions in the market within MPS, and it's really trying to move the industry forward. I'm joined today by Lewis in Ireland this morning. So Lewis, brief intro from yourself.
Good morning, everyone. So, yeah, my name is Lewis Brasso. I joined the business back in October 2023 as head of strategic partnerships. As Lee pointed out, definitely across the UK, Northern Ireland today, Southampton yesterday, London earlier this week, London with you guys last week, Leeds next week. So yeah, definitely out a fair bit to say the least. Yeah, I actually started off my career in financial services, actually working for one of the largest financial planning businesses in the UK, and basically helped them grow their UK footprint to quite a reasonable size now.
Great, thanks, Lewis. So yeah, the next sort of half an hour, 35 minutes, do a brief intro to Aspen, then we'll get into things, sort of looking at goal-based investing. I'm very much of the belief of trying to move progress the industry towards goal-based solutions. Clients tend to have goals rather than risk appetites. I fully understand the risk still forms part of that discussion. And then within that, kind of catering for people that have various different types of goals and time horizons, quite often relating to protecting the real value of capital and long-term growth. So we'll look at some capital preservation options that are in the market and those that have been popular, look at the capital growth options in the market, and then we'll kind of bring it all together. And we thought that the best way to do that is looking at the retirement piece, because it is quite a popular and interesting debate and discussion at the moment. And obviously it includes both elements within retirement. So there is the protection element, and there is, if someone's 70 years old and in good health, there is still that growth element in there as well. So that's what we'll kind of bring it all together in at the end. And then Q&A at the end, but as we said, please do ask throughout. So just a brief intro to the Aspen business. We're MPS, multi-asset specialists through and through. That's all we do. We look to be best in class at that. And I'd say our 4 key areas of difference in the business is that we have the most comprehensive range of portfolios probably on the market. That's not just endless risk categories, it's the combination of our main portfolio ranges as well as our satellite portfolios. So you can really use these two to create sort of outcome-led solutions for clients. We have some great tech that we provide as part of the service, which Lewis will give a brief demo of at the end, bringing everything together, fully white labeled for your firm. So that's been really popular amongst advisors. Service, super important to us. We're effectively a dedicated investment partner to your business. Anything that you need on the investment side, we are here to support that, whether it's client meetings, opining on a portfolio, views on markets, supporting when equities go through a tricky patch. Anything like that, we're here very much to support you and not just a provider of product. And then finally, being a relatively small firm, we are able to be nimble, we're able to get stuff done. We greatly value feedback that we put into the service provision, the things that we offer, and the technology that we deliver as well. So those, I suppose, are our 4 key areas of difference. Across the Aspen team, a pretty broad wealth of experience across investments, the business operations, technology, and sales. We really do focus on the investment side. That is our area of expertise. Some firms perhaps just all on the distribution side of things, but no, we really are. We care deeply about the investment piece, and we're very conscientious in that respect. So when you do speak to us and you want to have conversations around investments, you do come through to the investment team to speak in that regard. And then more broadly, in terms of the people that we work with in the industry, so we're on with a few networks. Now, risk profiling, which is obviously needed in the process of things. So we're with EV, De facto, Dynamic Planner, and we also have our own complementary risk profiling software if anyone wishes to use that. Research systems, there's obviously quite a few on the market as well, all the usual suspects there. And then we greatly enjoy the strategic partners that we work with. And there's a wee hole in there for our favorites one, the Financial Planning Club that we enjoy. That was my little PowerPoint with funds for.
I love the little spinning round logo as well. Thanks, guys.
So yeah, we really enjoy getting out and about and meeting people, and it was great to see the Financial Planning Club in their booth last week at the Verve conference. I thought that was very cool. So well done with that. Okay, so goal-based investing. There's 2 types of there's sort of 2 high-level objectives. We want to preserve the real value of capital, and by real, obviously, I mean the inflation-adjusted value of capital. There's not much point in protecting capital in any other way. So investors in this camp, they might be looking, as I said, to preserve their money against inflation. They might be approaching retirement. They might be in pension drawdown, and there's a bucket or a component of that drawdown that needs to preserve capital, particularly at the shorter term time horizon. They may be seeking a home for excess cash that they have, and they may generally have a relatively low attitude towards risk or capacity for loss. And also they may have a specific short-term goal. So they might have a tax bill coming up in 18 months' time. For example, they might have a house purchase in 3 years. They might have school fees in 7 years. So it's also, these goals and short-term goals and objectives that clients have that, fit in this camp of real capital preservation. And then capital growth, we're probably a bit more familiar with that. General investors are looking to grow their capital over time as part of their portfolio. Early accumulators are clearly in that high growth phase, people in their 20s, 30s, and 40s, very much in that high growth phase, but still obviously into the 50s and potentially into retirement. There's a component part of the portfolio that still needs to grow. Typically, people that are looking to properly grow their wealth will have long-term time horizons. So by that, we mean sort of over 7 years, whereas the capital preservation people are those with shorter-term time horizons typically. And generally, they have a relatively high tolerance or capacity for loss. But there's obviously then that big education people process of just people understanding that if you are largely invested in equities, that does come with with ups and downs, and it's about staying invested, during the course. So these are the typical characteristics of people in these two camps. So I'm just going to talk about what the options are available in the capital preservation side of things on the investment side. So I'd say first of all is the traditional low risk portfolio. And use here, for example, Vanguard Life Strategy 20, or just in the market you see conservative defensive type portfolios. Very typically, these will have high bond allocations. That might be short dated or intermediate or relatively long dated bonds. As we've seen in the last 5 years, depending on where one sat on the duration side of things in bonds, it has come, or in some cases, it's come with quite a lot of volatility, particularly in the 2022 period. Anyone that had sort of 7-year duration bonds probably saw a drawdown of around 20%. So it's important that, I was coming into 2022, I didn't really understand why, a bond duration of 8 years was assigned a one in risk, given the risk that was clear kind of in the market. And so it's important to understand what you're actually invested in on the low risk side of things when it comes to that. But this is the traditional low risk kind of option. Then you have absolute return type funds, and these have been popular over the years. I would say less so these days. Obviously, we had the flagship Standard Life GARS fund in the late 2000s and early 2010s. And then a few derivatives of that, Invesco Perpetual and Aviva launched versions of these. They can work quite well. They do have a low correlation to bonds and equities, so they're useful in that capacity. However, they are complex in their structure and process, and you can have a bit of an ice age of 3 to 5 years of low to no returns, and that's obviously what we saw in the GARS strategy. And it peaked at around 65 billion and then closed a few years ago with outflows. So I think these are less popular now. I think Ruffer do a pretty good job. They've been going for a good 25 years now. The business has evolved quite a lot with Ruffer over the years. It's perhaps a little bit more of an institutional rather than private client type business now. But Ruffer and Troy still have some pretty, a couple of good funds in that respect. I would probably avoid absolute return funds that are doing what I call funky stuff like shorting and sort of market timing, and focus those with longer time horizons like a Troy or a Ruffer in that respect. Then we have smooth funds. So these are obviously really popular still. And the proof funds, obviously the flagship strategy of that, with many tens of billions in it now. I say seems to do a good job. It does seem to do quite a good job. And it's relatively easy to communicate to clients because there's this nice line that just sort of goes up with the odd correction. It is quite an opaque structure, and if there was a run on the fund for whatever reason, that could cause some liquidity issues down the line. There is some private assets in there, and some less liquid stuff in these smooth funds. So the jury's out a little bit. I know it's a bit of a Marmite subject, smooth funds. I don't have a strong view one way or another. I don't fully kind of understand under the bonnet, if I'm honest. But it seems to do a relatively good job, and new ones are popping up as well in that space. Have we had any questions? I've seen a bit of activity on the chat. Is there anything I need to pick up on this?
No, it's just basically Kevin asked a question around risk profiling tools and why we use so many. I was just explaining we're risk profiled by a lot of risk profilers, but we do not use that many. I mean, that'd be a carnage if we did. But that's mainly down to popularity. But what we often see, and I think the stats around this are probably 60-70% of the marketplace now, are using the likes of De facto and Dynamic Planner. Quite personally, quite like EV's approach because they're taking time horizons into consideration more versus the others. And I think that should be a key part of the conversation when you are discussing risk, should be time horizons, especially if you're going down a different pot approach. But yeah, they're the ones I'd probably say most people are using at the minute. But obviously, we've got our own risk profiling tool that we provide complimentary for any firms that use us, which takes more of that goals-based approach and looks at time horizons more broadly.
Yeah. Yeah, risk profiling is yeah, it's a subject on
That's
my
another hour webinar view alone, isn't
yeah,
it?
right. Yeah, we should really be moving to a standardization of risk profiling, all these various. Anyway, moving on. Yeah, so smooth funds is another option, and then you have like ancillary options, so kind of other things. So obviously, cash in the bank is base rates around 4%. You can get a reasonable return in the bank, or there's cash funds. So we have a cash plus portfolio, for example, which is largely money market funds. That's a perfectly good option. Yields that 4% or so at the moment. Premium bonds, an option. Gilts portfolio. Now, this has been really popular in the last 2 or 3 years. This buys short dated, so under 2 years, low coupon gilts. When rates were at 5% or so, super attractive for higher rate taxpayers buying this because you get the capital with rates going from 0 to 5%. Low coupon bonds have fallen in value. And so as they approach maturity, they pull to par, and that is tax free of capital gains tax. And so it was a great way to get nearly 5% tax, mostly tax free. So that was really popular. Rates have come down a bit. So you're still getting, 3.75% or so, largely tax free. So it's still quite a nice solution. It's not quite the slam dunk it was a year and a half ago, but it's still pretty popular. And then structured products, less popular these days, but you can craft something in that respect, synthetic zeros and things that could work. But I would say a lot of low risk solutions do feed off base rates. So if base rates are 4%, you can get pretty decent returns off most low risk solutions. So at the moment, there's some relatively attractive options in that space. They shouldn't be completely discounted as options. So moving on to capital growth, which I think people will probably be more kind of familiar with the options here. An equity portfolio or largely equity portfolio. So this is where MPS, DFM type solutions or multi-asset funds kind of come in. Very common, very popular, active and passive variants clearly, and do a pretty good job at growing capital. So there's obviously a lot of options in the market, and always happy to kind of talk about ways and means of filtering that down. You've got like, an equity fund beyond a portfolio. So that's a single line item. So you could have a multi-asset version of that, like Vanguard Life Strategy. So Vanguard Life Strategy 80 or 100 is very much a growth mandate. Or you can have specific, obviously, if you're building a portfolio, specific, funds, whether it's a global equity fund or a regional fund. So these are all capital growth type solutions. So Pacific, North and South, an equity fund, for example. Again, the fund side of things is popular as well, and you have active and passive variants of that too. And then some ancillary options that are available to people. There's the IHT or tax advantageous options of AIM, VCT, EIS, and SEIS that are UK is relatively attractive actually in terms of the EIS and SEIS schemes that are on offer. It's very useful for offsetting income tax. Private equity. Now this is a bit of a Marmite topic as well. This is, a lot of companies in the world are actually private, far more than public companies. And actually, if you look in the US, there's been a big drop over the last 10 to 15 years in listed public companies and, a big rise in private companies. The issue with private equity at the moment is liquidity. It's very tricky to exit. Private equity. There's a lot of admin that comes in with investing in private equity, and then there's also just the fair market value of valuing these businesses. So I get there's a lot of friction to private equity at the moment. This is where I think tokenization will be transformational for private equity down the line. So I think stay open-minded around private equity would be my view. I think if the the means of access can improve, then I think it will probably start to come in the years down the line as a viable kind of. And then finally, structured products again. You can have quite high capital growth type solutions such as super trackers that do X% of growth of an index, or auto call type products that have been quite popular over the years. So those are some ancillary options. So those are sort of the main options in the defensive preservation of capital and the growth capital side of things. So we're going to bring that together in looking at building a protection and growth portfolio in retirement. So in our view, so we're just going to focus a little bit on the CRP side of things at the moment, but it's really just bringing together the protection and growth side of things because it's a really nice case study for that. So a robust central retirement solution for us needs to be simple for clients to understand and for one to implement. Versatile to allow for changing circumstances in retirement. I think that's really important. Reliable to have full confidence in the process, and repeatable across a client base and the business. And so for us, we have, as we said in the last few years, canvassed opinion and stuff. And so we do, believe quite strongly that the bucketing approach works well. You can have that liquidity pot, so 12 months to 2 years of cash. The lifestyle pot, which is like sort of aligning the strategy with the current and desired way of living for the next 5 years, and then the longevity of the pot over time. And so let's take an example client here. So let's say someone is retired with a pension pot of around £1 million. They're 70 years old and in relatively good health. Their expected time horizon is feasibly 20 years, and they're a medium risk investor. The requirements are they need 50k a year or so from this pension growing with inflation. They want to avoid significant volatility and sequencing risk type scenarios, and they would like to leave some legacy to their children. So the solution using the sort of bucketing approach, and here we're introducing a few Aspen portfolios just as an example, is this sort of structure. So the first 2 years in what we call liquidity, the next 5 years in what we call lifestyle, and then the balance in that sort of longevity type scenario, so where time is on your hands. So the liquidity would be sort of platform cash, or we have a cash plus portfolio, for example, that yields close to base rates. That's for 2 years worth of income, so £100,000 of that. The lifestyle phase is something sort of in the low to medium risk hand. So this is where you may look for, a proof fund type smooth fund, for example, if that's something you're interested in. We have our Four Seasons portfolio. Really, you're looking for something that can, be relatively reliable in this sort of 7% or so return. So beating inflation and with a medium-term time horizon. And then longevity is then really quite an equity-related strategy. So like an 80% equity portfolio. So here we've gone for the Aspen Growth Passive solution for that. 7+ year time horizon, time on your hands to do that. So this is the structure that we sort of work with as a base case, and it seems to be quite popular and easy to explain and understand for the client. And what you see here is this is a balanced or medium risk client. And what we've done is we've lowered risk at the front end and raised it a bit at the longer end. So overall, it's still a balanced client, but you're putting more risk where you've got more time and lowering risk where time is shorter. And so this really helps with sequencing risk and also financial anxiety for the client. And yeah, the all-in cost for this is around 0.38 or something. So very much cheaper than, a sort of standard or classic or historic DFM type solution that would build, this type of structure. And then in terms of returns, you can actually get quite a favorable return structure for this as well. So this is that portfolio structure that I've done relative to NPS, moderate, balanced, and growth kind of benchmark. So, good risk-adjusted returns and good total returns. So there's no real sacrifice on returns that you get from structuring things in that way. If anything, we would like to, hope that you get a kind of premium of returns kind of over that with useful. So I'm just going to touch briefly on the Four Seasons portfolio because I understand that was a middle section that people wouldn't be that familiar with. And this kind of comes into that probably capital preservation type scenario. The portfolio is looking to preserve and grow the real value of capital by balancing the growth and inflation factors using a tried and tested blend of bonds, equities, and commodities. So doing something, no shorting, no market timing, nothing like that, just relying on assets doing their thing over time to try and deliver on that smooth return profile. So the target market are those similar types of people that I said in that capital preservation side of things before. So I'm just going to touch on how the Four Seasons portfolio is built briefly. So any environment that we find ourselves in can reasonably be put in one of four camps. Either economic growth is going above trend or below trend, or inflation is going above trend or below trend. So spring is a disinflationary boom. That's the 1980s, the 1990s, and the 2010s. A pretty good environment where growth is strong or above trend and inflation is relatively low. Summer is an inflationary boom in the late 60s, the late 70s, and the early 2020s. Autumn is stagflation, the 1970s and the early part of financial crisis. Inflation is rising and growth is falling. And then winter is that deflationary bust, the Great Depression in the 30s and the financial crisis. We can also put January, sort of February and March of the COVID pandemic in that camp, growth falling massively below trend and inflation falling below trend, before we then move to that top right quadrant in 2022, where inflation then started to move above trend. And so what we look to do is to isolate what assets do well in each of those four environments. So equities tend to do well in that top left quadrant. You want value stocks, emerging markets, and commodities in that top right quadrant. In the bottom right, where it's inflation rising and growth falling, you want inflation-linked bonds and gold. So that's why we're seeing gold do particularly well this year. And in winter, you want various duration of sovereign bonds, cash, and min-vol stocks. And so what we do in the Four Seasons portfolio is allocate 25% of our risk to each of those four camps, which creates this asset mix of holdings. So cash, bonds, equities, and commodities. You see great diversification in here amongst the various different styles within equities and different types of kind of bond allocation. And so for us, this asset allocation, this asset mix, be it the Great Depression, world wars, economic booms, economic busts, inflation shocks, this asset mix has sort of weathered them all. So this is that asset allocation over the last 50 years, net of fees, which has delivered around that 7% return with relatively low volatility. So for us, this is a flagship sort of low to medium risk offering. We've got a fund and a portfolio version of this, and it's doing everything we would hope and expect this year, for example. So this is it over the last 50 years, sort of that asset mix. And this is it live sort of this year. Obviously, equities have been on a bit of a roller coaster, but the Four Seasons strategy has been pretty reliable for 7% or so this year with relatively low vol. So Lewis is going to bring all that together briefly for the last sort of 7 minutes or so before we have any final questions. So over to you, Lewis.
Yeah, thanks, Andrew. What we'll do as well as part of this demo is really bring in that sort of preserving and growing capital together for a client, especially looking at client might have some different time horizons for their goals in particular. So if I just share my screen, hopefully you can see the tool now in front of you.
Yep.
Yeah, awesome, fantastic. Yeah, so with this, what we're trying to really do with the tool is really bring that concept to life around retirement planning, or even just looking at that growing, preserving capital wealth in general. So on our tool, you can get a variety of different things available on here as well. So you can simply get our PowerPoint presentation, for example, which is on staying invested. So staying the course, this is under useful resources, so it's available via our portfolio discovery tool. And it's basically just walk through with clients actually why you don't want to react to markets and why you want to stay invested, especially with having client conversations around things like cash and why you want to be invested versus holding cash. We've got some really useful infographics, just really trying to help educate clients. It goes back to one of the points you mentioned earlier on, is how can you just educate clients and communicate with them around why you want to invest in the first place. You can also get fact sheets that can be completely in your branding, or they could be in ours. We do complimentary white labeling as part of that. but just nice, simple market updates and portfolio positioning for the clients, just to make them understand what they're investing and why, and hopefully give them a bit more peace of mind over the months ahead as well. Similarly to that, we also do monthly market updates, which you can get by here as well. It's a nice, simple one-page market update, and then on the back, it's a simple Q&A section. These are immensely popular with the firms we work with and are really helping client conversations. They're completely neutral, especially if you have them in your branding. They look really nice, they have a nice premium feel to them. So if you are using us and some other people alongside your CIP, you can use them across your entire client bank because we don't talk about Aspen portfolios within here. So main parts of the tool. One, if you really want to try and educate a client more on risk versus reward, we do have some interactive and charting functionality. So you can actually explain to a client what does a medium risk client look like versus medium high risk. And you can look at that over time. And you can also do things like toggle off and on inflation. You can show the client world events. You can show the market downturns. But you can customize the values, the ranges, whatever you want to do, just to bring it to life more for that particular client. So it really does start to resonate with them a lot more. But the main part of the tool, and what Andrew mentioned, and what we'll show you today, is this bucketing approach to wealth and what we're going to do for that. So I can simply build a portfolio. I'm going to use a guided portfolio builder to show you what this looks like. So let's just say Andrew's our client today. And what we then start to do is start adding the investments we're looking to do a recommendation for. So say, as Andrew's case study he looked at a minute ago, say there is a £1 million pension pot that we're looking to do. You can add multiple tax wrappers, though. You can literally do whatever you want on the tool from that point of view. So you can now start to either create your own goals for the client. Alternatively, just simply use our centralized retirement solution and the three goals that align to that, which are the three goals that Andrew mentioned. So we've got liquidity, lifestyle, and longevity. And again, to help explain what that looks like to a client, you can simply click on each of these and it'll walk through what each of those goals look like and why it's important to have that in your portfolio in particular. I now need to select a risk profile, which I can either use via Aspen system. Alternatively, I'm using one of the external suppliers. So going back to Kevin's question earlier, you can see how we map across all the different risk profilers on here. So let's just say we've got a medium risk client, what Andrew mentioned earlier for the case study today. So I've now got my goals, I've got my pension. So how are we going to allocate wealth? Because we know for this particular client, they're going to want a couple of years worth of income, probably in cash, just to really help avoid sequencing risk, because this is that shorter term horizon that we're looking for this particular goal. So let's align a pension to that. And let's just say, using Andrew's example we mentioned earlier, we're going to go with cash plus, and we're going to add, say, £100,000, which is the first 2 years worth of income. So we got that in there, brilliant. We then want to look at that middle bucket, and this is that preservation of capital whilst also trying to grow it, which is often the hardest part for a lot of people to think of solutions for. But hopefully, the likes of Four Seasons and other smooth funds on the market at the moment, you can really get some good options for that sort of 2 to 7 year time horizon for a client. So let's add the pension again, and let's just put the Four Seasons portfolio in there as well. And let's say we're going to put 5 years worth of income, like Andrew's example we did a minute ago, in that particular pot. So now we've started to take a lower risk at the front end. What you can actually see when we look at the aggregate risk profile at the bottom left here is, based on allocating money towards Cash Plus and Four Seasons, I'm actually outside of my client's risk tolerance. I should be closer to a 3 out of 5 in risk, but I'm down at a 1.7. Now, if I was saying this was a balanced investor, going to put it into a normal balanced portfolio. So let's just put the balanced passive plus in there as a good example. And let's just use now that remaining amount of £650,000. Yes, I'm actually within my risk profile. So risk profile for here should probably be somewhere between a 2.5 and a 3.5 if we're really trying to hit that medium risk profile. But I am quite low on that risk profile banding point of view. So if I was to then get rid of the balance solution and look at a growth portfolio instead and really try to look to grow capital for at least 7 years plus, and also put that into the growth passive plus portfolio, what we'll now start to see is, by allocating more money into a higher risk solution with a longer time horizon, overall, I'm actually much closer to my client's aggregate risk. So this gives me the ability to really start to tailor a solution for client, help protect capital for their shorter term horizons, while still trying to focus on growing, maintaining capital, especially in the medium and longer term as well. So I can do this now. I can finish and save. And what the system will do for me is produce a nice, friendly report. Again, it can be in our branding or completely white labeled, whatever is your preference. And that report will effectively walk through how we work with you, how you work with the client, while you've looked at the recommendations that we have. So as you can see in front of you here, so we've got why we work with you and how you work with the client, the solutions we're looking to do the recommendations for, what were the goals? So we agreed that this was a centralized retirement proposition. So the goals are around liquidity, lifestyle, and some longevity planning. Agreed risk profile, and then we've got the recommendation broken down by goal instead of tax wrapper, and we've got the agreed aggregate risk profile at the end. And then what you've got is all of our fact sheets that are pulled through. So you've managed to be able to tailor a solution now that does help preserve and grow capital for a client, but you've done it in less than 5 minutes, and it's really helping bring the story to life of why you want to maybe look at that more goals-based approach to investing. But yeah, as Andrew mentioned, this tool is completely complementary and something that a lot of advisors are using in their practice, especially when they're trying to use that more complex scenario planning of high net worth clients or with multiple varying goals or specialize in retirement as well.
Thanks, Lewis. So
That's
yeah,
the best
we're
stuff.
3 or 4 minutes from the end. Welcome any final questions that anyone may have
Yeah, feel
on
free to ask us anything.
this topic.
Loving the tech, guys. It seems to be growing arms and legs, doesn't it? From when we see it, from when I see it a while ago to
That's
where
it.
it is now. The user ability on it. You've not got to be an absolute tech whiz anymore to get your
This
head around
is
this sort of stuff.
I'm
100%.
such a big believer in simplicity of technology. I'm a bit of a technophobe myself, and so I need to be able to switch them on and be able to use them pretty much. I don't need 3 1-hour sessions of trying to understand a piece of software. So yeah, I think it's a really important thing these days in technology. I think financial services sometimes lets itself
Yeah.
down in that respect of overcomplicating things.
Well, this is it. You're not only simplifying it for the advisors, you're also simplifying it for the advisors' clients as well.
Yeah,
Yeah.
How
yeah,
easy you make that whole process
yeah.
when everything's always been known to be challenging, isn't it? Really, and
100%.
it's a minefield.
It's what we've noticed with a lot of advisors, and the same thing with conversations we've had over the coming months, is a lot of them, especially when things like the tools we've got there, for example, like the charting functionality, some of those packs, you're not going to use them in every single conversation with a client. But it's just that peace of mind knowing that if you are in a client conversation and we start talking about market volatility, etc., risk versus reward, wherever it may be, you've got something there at your disposal that can really just bring that story to life even more and help simplify things for clients. And I think if you look at the FCA retirement income review, that's one of the biggest issues they had with this space was actually there's a lot of complex solutions out there, and providers in particular could be doing more to help client understanding. So yeah, we're very fortunate to work with some amazing firms who are pushing that innovation front and trying to really promote good client outcomes. And they're exactly the sort of firms you want to work with, the people that are looking at how can we evolve, how can we adapt. So we're always consistently looking for feedback from firms on what they need and helping them build tools to support their conversations.
That's awesome. What's next for Aspen, guys? What's in the firing, or what's 2026 look like for you guys?
That's an interesting
Good
question.
question.
So yeah, Lewis is amazing at planning out our itinerary in terms of being on the road and stuff in the years ahead. In terms of like the business, we're 5 years in now where we've got all the plumbing in place, track records are great, we've got great clients, we're on all the things that you need to be on in terms of risk profiling. So we're in a growth phase. We really enjoy working closely with the firms that we work with, and so yeah, next year is just the extension of that growth. We're going to work hard on the technology. It's we've been speaking to our technology providers on this and what we've got planned for next year, probably bringing everything a bit more together in terms of kind of a full suitability journey that one can do through the Aspen piece of software, and as I said, just making it really super user friendly and easy in that respect. In terms of new products that we're bringing out, we've got a very comprehensive range of portfolios, so probably not going to make too many changes to that. We always, with our satellite portfolios, we have 7. When rates rose from 0 to 5%, we rolled out quickly the gilts portfolio and the cash plus portfolio. So we'll keep an open mind as to what might work, what might be interesting for people on the satellite side of things. At the kind of left field end, we've got the Bitcoin access rules coming down in the market. So we're seeing if there's any appetite from advisors, from clients to hold Bitcoin in any capacity, and so we could have a satellite portfolio in that respect. So we try to keep an open mind. We try to provide great tools for advisors, and so a continuation of all that.
Yeah, I think that's the good bit of being nimble is when the gilt rates interest rates start to rise and gilts, short duration gilts in particular, became a very popular option for people. That was the beginning of 2022, and we had the gilt portfolio live by the middle of next year. So a lot of our clients have reassurance knowing that going into 2026, whatever things are chucked in their way and solutions they need, they know that we're going to provide them in a very timely way. So it's not like we're planning to launch our gilt portfolio next year, even though the opportunity was probably 4 years ago, like some of the peer groups. So it's nice being able to actually be nimble and actually adapt to where people want us to be. But yeah, just continue what we're doing, partnering with more firms and getting more feedback. So yeah, the more innovative firms that are looking to grow their businesses and trying to scale, the more feedback we can get from them, the better.
Love that. Aside from people that will complete the feedback form and want to speak to you guys, what's the best way for somebody to get in contact with you? Where can they see you in person next? If you've got anything lined up in person
next Friday.
Well, stop it! Stop plugging our event, Lewis, like that. Have you got anything planned towards the end of the year? Can they come and see you in person? What's the best way of getting in contact with you guys?
Yeah, so now we've got a bigger team, especially as well. We've obviously got myself, Francis Hermione, and obviously Andrew as well up in Scotland. Obviously, done quite a lot of client meetings as well, part of that. So yeah, we'll send out our contact details afterwards for everyone. But yeah, simply just either request to meet us via virtual meeting, or if they want to see us in person, yeah, we've now got proper UK coverage, which means we can go out and see them, see everyone where possible. But we're going to try and ramp up the more localized regional events next year. So that's actually one of the things we have got coming for next year is going to be doing a lot more local regional events, but rather than sort of your traditional sort of product pushy type ones that a lot of other people have seen so far, basically take inspiration from what you guys do as well is how can you do the proper business development sessions. I think in a world where people have gone even more virtual now, people are crying out for communities like Financial Planning Club and just to meet more local people that are like-minded to them. So yeah, we're going to really ramp those up next year.
Love that. Well, just thank you again, firstly, for joining us. Lewis and Andrew, really do appreciate it. Thank you for everybody that attended and spent the morning with us. Please do complete the feedback form. We'd love to hear how you thought the presentation was today. Was it what you expected? Did you learn something? How can we improve our sessions? And importantly as well, I think there's a section, I think there is a section on this. What else would you like to hear from Aspen? So if there's any ideas or anything else you'd like to see Aspen go into a little bit more detail about, then that would be awesome.
Cool.
Until next time, I will stop the recording for this purpose, if I can find the stop button. But again, thank you very much for joining us.
Cheers, everyone.
Thanks, Lee.